Good morning, everyone. This is Stephen McDonald here from Blackburn Davis Financial. I hope everyone is in good health and good spirits. These are challenging times of uncertainty, confusion, and in some cases fear. So we wanted to do all we could to keep you informed, and as a result, we've organized this BCV Asset Management webinar for all of you. We thought it would be a good idea in light of the unprecedented events surrounding COVID-19 and the capital markets to give you the opportunity to hear directly from your portfolio managers. BCV Asset Management manages close to $2 billion in private client assets out of their office in Winnipeg. We are fortunate to have Chris Richards, Michelle Smith, and Todd Johnson, all whom are CFA charter holders, join us from BCV. Many of you know Chris, Michelle, and Todd already. A bit more of an introduction. Chris Richards has been with BCV for over 5 years, and he is the head of the fixed income investing department for the firm. Prior to joining BCV, he was a senior manager of economic impacts and valuation for the province of Manitoba. And prior to that, he worked with Great-West Life, where he provided investment management and portfolio analysis for their investment portfolios. Michelle Smith has been with BCV also for over 5 years. And prior to joining the firm, she was an associate at a leading Canadian investment management firm where she worked in investments and business development roles. Many of you know Todd Johnson. He was actually employee number 1 of BCV back in its founding in 2007. And prior to that, he had extensive industry experience working as a senior VP and portfolio manager at another leading Canadian private investment firm. Many of you will recognize Todd from his regular appearances on BNN. Before we get going with the presentation, we just have a few housekeeping items to cover. First of all, this is our first webinar, so we wanted to get this information out to you quickly. So please be patient if we run into any technology challenges. Number 2, during the presentation, feel free to ask any questions. All attendees' microphones have been muted to cut down on background noise and static. So in order to ask a question, please use the chat box provided in the upper right-hand corner. It says Q&A on the icon, and we will have one of the Blackburn Davis Financial team members bring these questions forward to the presenters. If you're not able to ask your question or you think of something afterwards, please feel free to send us an email or talk to the PMs offline via phone or email. We're all certainly happy to answer any questions you might have. And there should be an icon of a microphone under each speaker. Please make sure it's unmuted or you might not be able to hear the presenter. As this is our first time doing these types of webinars for clients, feedback is greatly appreciated. Even well after our social distancing requirements have passed, we may continue this sort of event. And it's always nice to understand how we can improve or whether or not this has been received well and provides value for everyone. So without further ado, Chris, are you ready to go?
I am ready to go.
Perfect. Thanks, Chris.
Thanks, everybody. Thanks for joining us. So today we kind of wanted to walk through 3 main steps. One, just more of a high level, what happened, right? What has happened since the beginning of the year till today that's kind of taken the capital markets by storm. Next, my coworker Michelle is going to kind of go through, just remind everyone our investment philosophy, kind of why, even in turbulent times like this, it makes more sense than ever to invest with a dividend growth philosophy. From there, Todd's going to talk about, where do we go from here? What do we know? What don't we know? And kind of why, we think, long-term clients are going to be just fine. So I'll start us off back to the beginning, which, felt like a couple of years ago, but turns out was only a couple months. So beginning of the year, we started to hear through news outlets of a case in a city called Wuhan in China of a disease that was kind of being passed around. It didn't get a lot of airplay, to be quite honest with you. It was more so just to be localized and was under control. First death unfortunately happened about early part of January, got a bit more traction in news media, but again, we were being told that, this is more localized, this is able to be controlled. This is not something that anyone North America-wide really needed to worry about. That is until probably about mid-January, when the city of 11 million people was cut off from the rest of the world, right? And at this point, they said, okay, we for sure have this. We are going to make sure that this doesn't leave this city of Wuhan. And for us on the investment side, we were kind of thinking, how does this impact, international trade and kind of that aspect, just because, it was told to us that it was going to be contained. Well, early part of January and into February, everyone kind of knows that Italy started to be really the hot spot for leaving China and going into Europe, and then what ended up being North America. The real concern that people really had is that we couldn't find who patient zero was to have the virus outside of China and into Italy for quite a long time. That really was what kind of spooked the markets and kind of started the downtrend. What actually happened, though, from the beginning of the year is we were having a great year, right? The beginning of the year was very strong. Economic indicators were up, and everything was doing well. We were kind of saying valuation is too high, but economics are doing really well. And then all of a sudden, once this virus took hold, all that conversation stopped, right? So the 19th of February was the last peak, and since then, this is the chart of the S&P 500 since then. And this is not just since then, sorry, this is until about mid-March. And, we were sitting here, we're saying, man, this feels really fast. Well, how fast was it? It was incredibly fast. The Dow Jones went from its last peak and into a bear market in just 20 trading days. 20 trading days is by far the fastest entry into a bear market that we've ever had. And there's probably a good reason for it. We've never really stopped a global economy in its tracks before, right? This is not something that we've tried and seen success before. And while the equity markets are what get a lot of headline news, what was happening behind the scenes really was a non-functioning of the bond market that kind of got the stock market dropping as fast as it did. So, about early March, we were starting to see that there was, plumbing that wasn't quite working in the financial system, that we weren't able to transact at reasonable prices. And this is not just, bonds that BCV holds or Canadian bonds. This is around the world. Very high quality bonds were just not able to be transacted upon. So, these are, if you're not able to sell items in the fixed income world, there's no liquidity. Well, where do you have liquidity is in the equity markets. Equity markets are open Monday to Friday, here in Manitoba, 8:30 till 3. So you could trade your Royal Bank, your, Enbridge stock, if you needed that liquidity. On the fixed income side, you weren't able to get that because it really is an over-the-counter market, which is to say it's relationship matters. So we have relationships with banks across Bay Street, and they were not offering, there was no other side to buy the bonds that we wanted to sell. And it's, again, not just us, that's around the world. So to kind of show you, this is the high yield index in the US, and in the span of about a week and a half, the rate of return that was needed to hold these bonds more than doubled. Up to almost 12% rate of return was required for individuals to transact in these bonds. So that's not normal, right? This is not something that we see all the time. So what happened, we were starting to get, growing concern. The central banks and the governments around the world really stepped in. So they said, to the rescue comes the Federal Reserve and the Bank of Canada. Now, I don't expect anyone to read all of these and to kind of, understand all of the programs that just were announced, but this is just a list of the programs that were announced over a 2-week period by the Fed in the US. North of $2 trillion has now been pumped into the financial markets to kind of unclog that, that financial plumbing that we were talking about before, so that people are able to transact with good certainty that the counterparty is going to be, kind of be there on the other side. So, these are great programs, and this is not like a 2008, 2009 where, we've tried a lot of these programs before and they worked really well. So Bank of Canada as well is not kind of sitting on the sidelines, the Bank of Canada over the past month has announced and continues to announce almost daily new programs to kind of help, people to, get money when they're out of work, keep people on payrolls. Right now, Government of Canada is buying corporate bonds and provincial bonds. It's never done that before, and that is to help that financial plumbing that we were kind of talking about, right? Making sure that everything is running smoothly. You might not like the prices that people are showing you, but at least the system is open and functioning like it should. So, and this again, I kind of wanted to highlight, is not just a North American issue. So this is around the world. We're seeing unprecedented levels of fiscal response and liquidity being provided to, by governments to individuals, not only on Wall Street, but also on Main Street, right? 10, 20, 30% of a country's annual gross domestic product is being put in to help support the business of keeping that country, out of a very deep recession. We're going to have some numbers come through that are going to be, not great on an economic side. However, we think that because we were so fast at enacting these programs, and these programs are so well designed for the issue that we're at right now, we don't think we're going to have as long of a recovery to get to a recovery as if we didn't do that. Right, so these are actually really smart programs. We are in uncharted territories, but they're programs that make good sense for the issues that we have in front of us. So that's where what's happened up until today. I'm going to pass the mic over to my colleague Michelle, who's going to tell you about BCV and kind of remind you of our investment philosophy and why it makes sense more today, more than ever.
Thanks, Chris. You're correct that we're obviously in unprecedented times here. However, this is not the first time that BCV has found itself navigating a challenging market. As Stephen alluded to, we've been in business since 2007, so our blue chip value investment philosophy has been tested since then. It's been tested through the Great Recession of 2008, 2009, the energy price collapse of 2014, followed by Brexit, and Trump's inauguration, to name a few. So the question is, what does BCV do in these times to protect client wealth? And the answer is that we stay the course. We do so by adhering to our blue chip value investment strategies, by focusing on the investment income generated by client portfolios, and by continuing to look for attractive investment opportunities for client capital over the long term. So I'd like to take this opportunity to briefly review BCV's equity and fixed income strategies. From an equity perspective, we follow a value investment philosophy, which means we purchase high quality companies trading in the market at what we deem to be a fair or below fair valuation. In addition, we ensure all the companies in which we invest not only pay a dividend, but that they grow that dividend over the course of time. And as a reminder, a dividend is a share of profit that management pays out to investors as a reward for investing in their company. From a fixed income perspective, we focus on investment grade and near investment grade bonds, as Chris talked about. The bonds are all issued by Canadian corporations. So by investing in corporate debt, investors are rewarded with additional yield. Bond portfolios are diversified by issuer, maturity date, and coupon rate. As I mentioned, BCV only invests in quality, so I'll elaborate a little bit further here. A high quality company is a company that is a leader in its industry. It therefore has strong and sustainable competitive advantages, which allows the company to build a moat around its business. As such, the company can consistently deliver stable sales and earnings growth. Additionally, the company is in good financial standing and is overseen by a strong management team. So a few examples of high quality companies that we invest in are Sun Life, CN Rail, and Microsoft. It's these characteristics that I just mentioned that allow these companies to stand the test of time and reward their shareholders over the long term by way of share buybacks, dividend growth, and ultimately share price appreciation. So we focus on dividend paying and dividend growing companies like Scotiabank. The rationale is threefold. Firstly, dividends create a growing income stream paid into client portfolios, regardless of what the broader market is doing. Secondly, dividends accelerate wealth accumulation over the long term. And finally, dividends provide cash flow that can be used to provide inflation-protected income or capital if necessary. Another way to consider this concept is by breaking down the components of total investment return over time. Total investment return is made up of change in valuation, dividend growth, and dividend yield. So over a 25-year time horizon, we look at change in valuation, which represents the majority of total return in year one. But as time goes on, the growth of the dividend and dividend yield overtake valuation and contribute nearly 75% to total return. Remember, dividends are paid from profits, thus an increasing dividend signifies growing earnings. In turn, growing earnings would be expected to drive long-term share price appreciation. So without the concept of a dividend, investors are depending solely on growth and share price, which we know can be irrational. Thus, dividend-focused investing provides investors stability in all types of markets. To further elaborate on that notion, let's review how a dividend-focused philosophy has performed in various markets. The following charts here compare dividend-paying companies in dark blue versus non-dividend-paying companies in light blue, and the overall market in lime green. In a bull market, dividend-paying companies delivered an average return of 24.3%, slightly higher than the other strategies. In a bear market, the dividend-paying companies were not hit as hard as non-payers and the overall market, falling by less than 14.5% and 3.5% respectively. Part of this phenomenon is due to the fact that the income stream from the dividend creates a cushion. Finally, in all types of markets, the dividend-paying company outperforms the other strategies by 6.9% and 1.7% respectively. This is partly due to the fact that when markets do recover, the dividend-paying companies have generally less ground to reclaim, and therefore can rebound faster. With these ideas in mind, we're using the current market environment as an opportunity to buy pieces of great companies at attractive valuations. While there's no shortage of high-quality companies in the environment, BCV continues to focus on companies that will be winners and will also reward shareholders through the next economic cycle. It's during this time we're reminded of a quote by our beloved Uncle Warren: "Be fearful when others are greedy, and greedy when others are fearful." Finally, I'd like to focus your attention on two companies that are widely held across client portfolios and that are stewards of value investing. The Royal Bank of Canada has all the makings of high-quality companies. It is the largest bank in Canada with a strong business and diverse client-focused model, allowing RBC to deliver consistent revenue and earnings growth over time. The bank is increasingly well capitalized and therefore can continue paying and growing its dividend over time. As you can see here in the next slide, since 2005, the share price of RBC has followed an increasing yet bumpy trajectory. However, its dividend has delivered a stable and growing income stream for investors. This is nearly a textbook example of the concepts we just covered. I'd also like to highlight Johnson & Johnson. J&J meets the criteria of a high-quality company in that it is the largest and most diversified healthcare company in the world. Actually, the company's focus on advancing health for humanity led J&J to announce late in March a lead vaccine candidate in the fight against COVID-19. Human trials are set to begin in September, and the first batches of the vaccine are expected as early as 2021. The company is committed to bringing an affordable vaccine to the public, and therefore is producing and distributing the vaccine at a not-for-profit basis. So it's this commitment to community and to humanity that has led J&J to deliver 36 consecutive years of earnings growth. The company boasts an even more impressive dividend track record with over 50 years of dividend growth. In fact, J&J reported earlier this week and announced a 6.3% increase to their dividend, demonstrating management's ongoing confidence in the future of their business. Furthermore, J&J is one of the last 2 US companies in corporate America to maintain a AAA rated balance sheet. That is a higher credit rating than the US government itself. It is these characteristics coupled with the company's resilient business model, strong product pipeline, and focus on corporate growth that lends J&J's share price to withstand trying markets. Seen in the next slide, the share price of J&J has fallen by nearly 16% less than the S&P 500 since January 2020, thereby providing shareholders stability throughout this current storm. This share price performance highlights that dividend-paying companies hold up well in challenging markets and therefore have less ground to regain when the market recovers. So now that you have a stronger understanding what BCV is doing to protect your wealth, I would like to invite my colleague Todd to discuss where markets and BCV may go from here. Todd?
Yes, thank you, Michelle, and thank you, Chris. I still see Michelle. Thank you, Michelle and Chris, for going over those topics. How we got here and how fast the market has declined and actually rebounded a little bit, and what our philosophy is, and the types of companies that we like to own in these environments are good illustrations in these kind of times that are somewhat trying and difficult to navigate. So we're in Q1 earnings season now, and we've found actually lots of earnings coming out that are actually reasonable from an earnings perspective. Investors and markets and economic forecasters are trying to figure out where we go from here, what the market will do, how fast we recover, when we go back to work. And so we are getting lots of questions on, the 1 month, 3 month, 12-month outlook. I guess from our perspective, we're not as concerned with the, whether we recover, 2 months from now, 1 month from now, 4 months from now. We are confident that the companies we've invested in will prosper through these difficult times. And, 2 years from now, 3 years from now, valuations will likely recover to normal. Our dividends will grow, and our companies will likely have swallowed up their potential weaker competitors. So times like these are challenging because economic investments and all sorts of things become uncertain. But if you've owned resilient enough businesses and companies, it's actually not as worrying as if you're in businesses that potentially have liquidity challenges or could go bankrupt. So undoubtedly, there will be businesses that go bankrupt and have different owners. But the companies that BCV owns and owns for their clients, we won't have any. In fact, we don't expect any dividend cuts as well. We expect our companies to hold their dividend. In fact, the company that Michelle just went over, one of them, Johnson & Johnson, just raised their dividend 6% this quarter. So it is uncertain. It is difficult times in the economy, but we don't invest in the economy. We invest in high quality businesses that have grown over a long period of time. And we monitor and watch them closely, and they will get through this, and they will prosper and do very well. And with that, we have no doubt whatsoever. So, in difficult times, sometimes it's nice to look at what would perhaps the most successful long-term investor in the U.S. have done, or what quotes has he said that could apply to situations like we're in now. So I thought I'd throw a few quotes up here just to kind of give perspective, because you hear on the news all sorts of things of, we're going to go, something bad's going to happen, and also, try to prompt people or investors to action that perhaps is not long-term wealth accumulating. At the end of the day, we're trying to ensure that we grow your wealth conservatively over a 3 to 5 year and longer investment period. So Warren Buffett has made this statement: don't take your 1 year returns too seriously. We've seen actually great 2019 returns. Don't take those too seriously. 2020, likely not going to be a great year, but the 3 to 5 year rolling average, those are things you want to make sure are meeting your expectations and meeting your long-term financial plan. Timing the market and trying to figure out where markets are going to go, once again as well, we don't think is a whole lot of value. If the market closed for 5 years, that's a BCV, we prefer to probably like to make some trades, but we believe all our companies would be worth more, have accumulated tons of cash, paid their dividends out, and even if we couldn't trade them for 5 years, our investors would get satisfactory returns. What we've seen actually in March was a very big shock to the system in terms of where corporate profits are going, but it also showed up a lot of liquidity. Chris had mentioned that bond market stopped trading. There was a lot of quant trading. There's a lot of quite computer algorithmic trading that wasn't programmed to handle a situation like that. So we got forced selling of people that just had to sell, and markets were in a bit of a free fall. So corporate profits, the long-term value of a business is the long-term profits of a company. March, when the markets fell 30%, the company's long-term profit outlook did not fall 30%. That was a result of liquidity and leverage. We know what we're doing here at BCV. We've owned these businesses for a long time. We've followed them for a long time. Owning a great company and a solid business it works longer term. So there's no ignorance from our perspective in terms of businesses we own and what we think they can do over the next 3 to 5 years. And this is common for many investors. The rearview mirror is always very clearer than the windshield. We cannot see precisely what's going to achieve. That's why we invest in companies that pay dividends, growing dividends in industries that we understand and businesses that we like, because the short term is more difficult. But staring at the rearview mirror and expecting that to extrapolate and continue is a very poor way to drive and a poor way to invest. And this is an interesting comment from Warren Buffett. Expect the market to fall 50%, some of your holdings to fall 50%. Without that understanding, you might not be able to handle a long-term approach. And this is from someone who invests in high quality businesses as well. And the reason is because of liquidity, leverage, panic. Unfortunately, human beings are prone to emotional reactions, and unfortunately, long-term profits of high quality businesses don't decline 50% in a year. But the markets can sometimes do that. And we've seen that in the great financial crisis where top to bottom it was down about 50%, and we've seen almost a 30% decline over the last month and then a quick bounce back. So quick volatility and drops should not be a concern. It should not be a risk metric, but it is something that we will see going forward in the future as human beings have not changed. So this is a big picture, long-term picture that we actually sent around to clients. You'll see it's familiar. We sent it around probably about 4 weeks ago, and it was just to give a sense of the difficult times that markets. This is a graph of the S&P 500, so the 500 largest U.S. businesses and companies from 1973 till 2020 in February, and the things that the market has had to gone through that investors would have thought are extremely significant, and how can we go forward from here? But yet, businesses and high quality companies and ingenuity over the long term moves a stock market forward, because over time corporate profits have shown an irreversible increase in value, and what we do, we watch a growing dividend with those earnings. So recency bias is always kind of the biggest thing. This crisis is different. This is bigger than anything we've seen before. But when you look back in the past, there was lots of challenges in the past, and good companies got through it. Some companies went bankrupt, but high quality businesses and great companies, got through that and got to the other side. So what we would say is control what you can control. Media and news are paid to get advertising. They're paid to get people to watch. So they're incentivized to unfortunately put the something that will attract you. Now it's not all not all incorrect news, but it unfortunately can be packaged as in a way that causes undue investor stress. So our long-term focus is meeting the income needs and investment objective of our clients, and we're always going to focus on that and focus on our core things that we think make sense for investment portfolios. And so with that, I wanted to turn it over for questions. We do appreciate your trust in us, obviously, and are here to take any questions that we've talked about or anything that you'd like to discuss with us. Back to you, Cindy.
Thanks, Todd. So we're going to start some questions here that have come in from clients, Todd and Michelle and Chris. And I'll start with a question for you, Michelle. Would you characterize some of the equities in clients' portfolios with BCV as having gone down more than others during this pandemic?
Thank you for the question. I guess the obvious answer here would be the energy sector. We've seen the energy sector deal with the effects of COVID-19, just like all the other industries. But then the energy sector has also been hit with Russia and OPEC Plus having an oil price war simultaneously. So we've seen that sector be hit quite a bit harder. So We're watching the energy sector. We have two names in our client portfolios, which is CNQ, Canadian Natural Resources, and Suncor. So those are two of the biggest players here in Canada. They've been walloped pretty hard, but we have conviction that they will continue to run through this, that their balance sheets are in good shape, that the management teams have levers in place that they can continue to pull throughout this. We've also seen OPEC and Russia come to some agreements, so we've seen some recovery in oil prices. We do believe that there's going to be quite a bit of supply here for a while. The world is going to go to max storage, and then we'll have to just draw down from that till about 2021. We'll see prices recover even further from there, and we'll see those businesses improve as oil price improves as well.
Thanks, Michelle. Another question that came in, I'll address for Chris to answer. A client's heard that the government is selling bonds now. Is this to finance their expensive aid program for laid off or underpaid workers and businesses? What typically happens to such bonds, and would it be worth buying any of them?
Yeah, the government's always issuing bonds, and for sure they are issuing a lot of bonds to pay for all the programs that have been announced, right? People who are a bit affected by COVID-19, they are now getting, checks coming in every month. So that money has to be paid somewhere. Government bonds, we have, there's not a lot of people who have enough capital saved in their investment account to live off of a long-term rate of return that government bonds are going to have, which is right now around about 1%. Right, and we think longer term, this rate isn't going to go too high. We have got a lot of debt as a nation, and we have to pay this bill when it comes due. So we think that interest rates are going to stay lower for longer than what people might think, leading to probably unsatisfactory returns in government bonds. People have been looking for yield, and we still think that the corporate space where we buy bonds for clients makes a lot more sense. We buy conservative bonds that are paying right now multiples higher than government bonds, and these are bonds that are backed by cash flows from real estate, from banking, pipeline companies, really solid bread and butter companies here in Canada. So we aren't buying any government bonds, but we are continuing to operate in the bond market just within the corporate space.
Thanks so much, Chris. I'll address this one to yourself, Todd. A client said, I heard that Bombardier is starting mass production of ventilators. Will their stocks go up with this enterprise? And what typically happens to this kind of wartime surge in business?
Yeah, Bombardier's business is not going to be dependent on ventilator production. It's good to see the company doing that. They have a lot of manufacturing expertise. Bombardier's business has been challenged because it's been, it was somewhat misrun because they built a great plane, but Airbus and Boeing were far too strong competitors. So they've had to sell that plane to Airbus for not as much as they developed it. But Bombardier has a great train business as well as a market-leading business jet business. And they're in process of selling their train business to Alstom, a French giant. So that transaction is going to likely close next year. And so Bombardier's valuation in their business is more or less that the bond we own is dependent on that sale going through and the business aircraft that they continue to actually do very well at, continue to move forward. Business aircraft are a little different than commercial aircraft. Commercial aircraft flights are going to resume at some point, but that business is under a lot of strain for their larger competitors, Boeing and Airbus. But business aircraft is a little different market. So we wouldn't say the ventilator business is going to impact Bombardier's bond, but we do look forward to the sale of their train business to Alstom to bolster their balance sheet.
Thanks, Todd. I have a question for you, Chris. With unemployment reaching record highs and major household debt, business debt, and now huge government debt, some economists are talking depression. What are your thoughts on the possibility of a major depression?
I would say if we didn't do the government programs, we would have a better chance of a depression, right? And these programs were needed. They were correctly enacted, And the speed, it's hard to create programs of, in the US, several $1 trillion within a couple of months. We will get back to work, right? I mean, we're talking now about, opening up the economy slowly. What that looks like and what that means, I don't think we're back to, going to giant public events anytime soon, but the gates will open, right? This spending on these programs alleviated a depression. We're keeping people solvent, because you just got to think of the domino effect of, if someone loses their job because COVID-19, well, then they don't spend money, they don't pay their mortgage, they don't pay their rent, and that's the spiral that you can't get out of in a depression. So doing these programs, I don't think we're going to get into a depression. We will open back up again, right? We see an end result. This time, I always say, every recession is different. This one is definitely different. We've never done this before, but there is, in fact, an end game, right? As soon as we have a vaccine that we can mass produce and we have herd immunity to this disease, we were in a healthy spot before this. Governments were starting to pull back a little bit from supporting the economy, and the U.S. Canadian more stretched than the U.S., but everything was working okay. Our biggest concern before this was trade tensions. That seems like light years ago. So for us, we don't think that we're going into a depression. We will have some hard economic numbers coming out. It's not, it's not something that you can just flip a switch on, right? We're starting to get good antivirals. Gilead just announced, some, they haven't announced yet, but looking like some pretty positive signs on treating the disease. That's the first step that we were looking to see. And as soon as we do that, and the faster we can get remedies and the faster we can get a vaccine, the faster we will put this behind us, and that depression notion won't be there anymore.
Absolutely. Thanks, Chris. I've got a couple questions that have come in that I will address to Todd. Todd, what would you say overall are some of the best investment strategies during this time?
The best investment strategies during this time are to buy businesses that have been hit by short-term investors with a short-term focus, that their long-term fundamentals have not really been impeded. So our investors are taking a short-term outlook where the business long-term has not been impeded. One of the ones actually we recently added to was a company called Brookfield Property Partners. It has a large office portfolio, but also a large mall portfolio. Obviously, malls are not being used now, so valuations on that business has declined presumptuously. But people will be shopping again, 6 months, a year from now, and the valuation of that whole business and the revenues from it will bounce back. So that's one example of a investment that's shorter term that's been hit, but longer term the real estate and those assets are good income generators, and the valuation will rebound.
Thanks, Todd. This question will kind of be part of what you've just answered here, but clients asked how much volatility you expect in the short term and medium term. So in the short term, 1 to 3 years, medium term, 3 to 5 years out.
Volatility it's somewhat been increasing over time, and the reason why is there's a lot of money that's traded electronically and algorithmically traded, and a lot of those strategies sometimes have some of the same feedback mechanisms, so they can enhance volatility. So there was financial changes made in capital markets after the financial crisis, which causes less market making. This is perhaps too deep of an answer, but it's resulted in more volatility systematically. There's not as much risk necessarily, but the trading of securities unfortunately has bounced up. I would point to what's called the flash crash, happened about 6-7 years ago, where a company like Procter & Gamble fell 20-30% in like 10 minutes and then bounced back. So expect those things in the future, but it's important not to equate volatility and risk. And I think I've tried to relate that a business fundamental that's solid, that's growing over a long period of time, its gyrating price is not really a concern to a prudent investor. And so I would try to steer away from that, equating volatility to risk. That's, I'll tell you, short term. I wouldn't say that's any different from the long term. I would say our next 6 months, 9 months, we might be a bit more volatile, as Chris just mentioned, as treatments, as how the economy opens up and how business fundamentals improve. We might see elevated volatility, probably pretty normal over the next 6 months. but after that, it will normalize again until the next crisis, which will happen again, which will be different. Nevertheless, we'll manage that as well.
Absolutely. Thank you, Todd. So last question for you, Todd, and then I've got one to throw at Chris. But do you foresee any changes to the weighting of US and Canadian equities in your portfolios?
Yes, it's a good question. So we have a collection of roughly about 40 businesses in our North American model. It's roughly equally weighted, it's towards 20 stocks in each model. In client portfolios, there's some tension between the growth of Canadian investments and the growth in the US investments. Ever since 2014, there's been a massive differential in terms of outperformance on the US side versus Canada, and it corresponds to the oil price crash in 2014. So what we find in Canada is valuations are cheaper. And what we find in the US, valuations are a little bit more expensive, but the companies are growing faster. So we prefer a relative blend of roughly half and half, simply blending the valuation, but a bit more growth as we find some of our US businesses. Some of our faster growing businesses have been on the technology side, on the US side. So going forward, we believe lots of our Canadian investments are quite inexpensive and the dividend yield is quite attractive. And on the US side, we find a bit more growth, but we're paying a higher valuation for it. So we're not making a big change from a global, from a sector basis, but you will find portfolios tilted sometimes to a higher weighting in certain businesses that are on the US side. And that's how I would answer that.
Thanks, Todd. Chris, we've got a question here. With some of Europe seeing negative interest rates, what do you think the likelihood of this happening here might be? How might that impact portfolios?
I'd say Bank Canada's kind of said that they are at their lower bound at 25 basis points. So they pretty much said we're not going to negative rates. And the reason for that is because it didn't work. They've tried it in other parts of the world. And what actually happened is it was the reverse of what they were hoping, right? If you got negative rates, it was supposed to get people out there buying and spending and getting some inflation and kind of getting economic activity going. But what actually happened is that people said, well, I'm not getting any returns in my equity, in my savings accounts. I'm going to hoard more money because I need to save more for retirement. And then also what happened is a big black economy started to increase more and people started dealing in cash transactions. So it was the absolute reverse of kind of what people thought. So we kind of view the negative interest rate idea as kind of a failure. It doesn't really work as indicated. So while I would like to think that mortgages would be almost at zero here or negative, I just don't see that happening, right? We're kind of at a lower bound at 25 basis points, and I don't see them going any further. As the economy kind of gets going again, kind of talking about the previous answer is we do think that they're going to want to let kind of the economy run a bit hotter than it has in the past. We're going to try our darndest to get inflation to pay back the bill that we have because of what happened now with dollars in the future that are, going to be paid with inflated dollars. So for us, I mean, that, screams that, equity should do well once we get through this, and we will, right? I mean, once we open up the economy again and we have the vaccine, we have the treatments, everything is going to be just fine. We just have to get through this turbulent time. We're not going negative, but, rest easy to all the clients. I always say, knowing the quality that you have in your portfolio. Right? These are the times, in these turbulent times, this is why you want to hold these great businesses, because they're going to be here for the long term.
Thank you, Chris. I have another question that I'll address to yourself. Somebody mentioned that you noted that we'll see hard economic numbers coming. Do you expect short-term share prices to drop in the next few months?
Oh, that's a good question. I would say that's baked in, right? I mean, everyone who has been watching any type of economic news or any news really knows that the numbers are not going to be great, right? We've been getting unemployment numbers that are not showing to be overly strong. GDP is going to be very challenged here in the short term. So will it surprise some people? Yeah. Again, we have no history outside of the Spanish flu to kind of point to. But we think that it is short term and people will not pay it the normal amount of significance that if this were like the 08-09 crisis as an example, right? We see an end point, so I think people will notify and just say like, yeah, these are bad economic numbers. We all know that they're coming, but this is a short-term phenomenon, and as we exit this, we will look back and we're talking about, is it a U-shaped recovery or a V-shaped recovery or some version in between? But we're already talking that because everyone can see the recovery, so the numbers will be hard to look at, but they will get better. And I think people will point to, okay, we know this is going to be a challenging number, but everyone's already looking past that and saying, okay, what's the next number going to be, and the number after that. And it really is that pace and the direction of the economic numbers that people have been pointing to, and that's kind of what we have been pointing to as well, right? It's going to get better faster than people think once we have the vaccine, once we have the drugs to be able to help people who have this unfortunate virus. But the numbers will be bad. They will get better, and people won't pay too much mind to the poor numbers because they're expected.
Great. I will address these next couple questions to Michelle. Michelle, a client's typed in here. Essentially, are you buying and moving around equities in the portfolio, selling some pre-pandemic stocks for purchase of others given large price swings? And if so, can you give some examples? And further to that, so with Federal Infrastructure Minister Catherine McKenna talking about the post-pandemic shovel in the ground ready project funding, are you looking at construction or any firms in this industry for the portfolios like SNC?
Yeah, so I'll start with the first question about kind of shuffling around. I think Todd alluded a little bit to what we've been doing. So from a firm-wide basis, what we've done is we've taken 2 trades, positions in fixed income, which have held up okay, and 2 depressed equity positions in Brookfield Asset Management and Brookfield Property Partners. So we've taken advantage of the lower valuations and lower prices that way. In terms of individual client portfolios, if there's some cash on the sidelines or cash from dividends and income, we've been using that type of income to buy more pieces. In terms of a relative trade from something like Johnson & Johnson that's held up really, really well into something like one of the oil companies, like I alluded to, that's been hit pretty hard. We haven't made any of those trades yet. That's not to say that those aren't in the pipeline. We've discussed a handful, just nothing was, I guess, compelling enough to get through to the finish line. So as we perhaps see more companies kind of rebound faster, trade in line with their fair or above fair valuation, and we see some companies not respond as quickly, we might see more opportunities to do relative trades or swaps within the portfolio that way. And then with the second question, in terms of infrastructure spend, we do have positions in Stantec, which is one of the engineering companies here in Canada. It's a global engineering firm. So we bought that company back in November of 2016, I believe, and we've held it since then. So Stantec has been the best performing company in 2020 on the Canadian side. It's held up really well. And the reason there is that their business hasn't been hit nearly as hard, just given the nature of the business. They have really long-term contracts with their clients and their customers. They also have about 80% of their company working at home, their employees working at home. They do just a lot of the design, and then the construction piece is through a partnership. So a lot of these employees have been able to work efficiently and effectively at home, so the utilization rate hasn't been hit too hard. We've been looking at other names within the space, but we haven't considered adding to anything at this point, just given because that sector has held up relatively well. Valuations aren't as attractive there as we might see in a banking or harder hit industries. Thank you, Michelle. We have one last question, and I'll keep it on Michelle for this.
Will the companies you invest in benefit due to increased nationalism due to a potential move away from China's businesses?
Yeah, that's an interesting one. We run diversified client portfolios for lots of reasons. So a handful of our companies are nationally focused, like AT&T, CN Rail, but we do have some global names in the portfolio as well, names like Apple. Some of the banks have international exposure. So some companies may stand to benefit. Some companies may have a more difficult time with the Chinese exposure. I think that was kind of a point that we were considering previously, as Chris mentioned, that there were trade tensions predominantly between the US and China before COVID really took off. So that was something that we were considering previous to that. Like I said, Apple, about 20% of their business comes from China, but we didn't really see any impacts to those companies at that point. So it's not something that I think we're too concerned about at this point either. A name like Apple is benefiting quite well. Any type of company that has a subscription-based model is standing up pretty well right now, with everyone at home connected, using the internet, using FaceTime, using apps, that sort of thing. So some companies with exposure to China may feel short-term effects. More North American focused companies may not, but that's part of the reason why we do have those diversified portfolios. So that something is always growing.
Thanks, Michelle, for that. Thank you to our clients. We don't have any other questions that have come in at this point in time. So I just wanted to thank our clients for attending this webinar, and we definitely would like to continue to produce things like this going forward if you do find it of value. And I really want to thank Todd, Michelle, and Chris. I think the last 30 minutes of your presentation and the time you've put into answering these questions has really gone a long way to helping all of us understand what BCV is doing right now to navigate these choppy waters and just prepare us for what lies ahead. If anyone didn't have an opportunity to ask your question, as we mentioned, Todd, Chris, and Michelle will be available offline, and we can make sure that you have your questions answered by them. And you can also email any questions that you might have to your advisor, and we'll make sure that it gets handled right away. So again, thank you. Remain healthy and definitely stay positive in the days and weeks ahead. Thanks for joining us. Take care.
Thanks, Kelly. Yeah.